Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but he's been covering gold and silver for many, many years. He's been in the investment and portfolio management business since 1992. He founded Profits Plus Capital Management. They also sell bullion at very low premium prices compared to a lot of the other bullion dealers. We'll talk about problems with the bullion dealers and premiums during the interview. And he also founded the Idaho Armored Vaults in 2008. He's currently the president at these companies. Bob Coleman, thank you for joining me.
I appreciate it. Thank you, Jason.
So, Bob, we're recording this interview on Friday, April 28th, 2023. The gold price is below $2,000 an ounce at 1,990. The silver price is barely around 25 when we're recording this interview. I want to get your thoughts on the commitment of traders, though, because I know you tracked this. So do you think that the commitment of traders is saying that there's kind of a contrarian indicator or a bottom coming soon?
Well, in terms of the commitment of traders, we saw back in March, about 3 days before you had the first banking collapse or the first bank go down, the commitment of traders actually showed that the speculators were net short silver. And in fact, they were only more net short in the last 3 years back in September of last year, which actually they missed the bottom. That basically was a great contrarian indicator because it missed the bottom by about 1 or 2 days. And so you tend to watch the commodity trading advisors that typically trade these futures contracts. They typically are momentum oriented price chasers. So you can, when they get too overloaded on one side of the boat, you tend to see a shift, and then that shift probably usually marks a high or a low depending on their positioning. So you can use it as a contrarian type of move.
A little over 6 weeks ago, we had silver, what was it, below 21. So it was headed towards below 20. And the gold price was, I think it was barely above 1,700. So we've had a big rally just in the last month or so. I think a lot of it's on the problems with these banks, with Silicon Valley Bank, Signature Bank, and now First Republic, which looks like it's going into receivership over the weekend.
Yeah, it's definitely, we're not out of the woods by no means with the banks, and people have to remember that the problem with the banks, one of there's a multitude of different issues going on at the same time. You have banks that obviously had received a lot of money from all the money printing that happened in 2020, 21, right when interest rates were at their bottom, and so the banks were forced to take in all these deposits. Then to try and fund those deposits, they had to go out on the yield curve a little bit to get any type of yield. And of course, then the Fed ramps interest rates up, and the value of their securities that they hold, which they did not have to mark to market because they were held to maturity. That's just a gap, a generally accepted accounting principle requirement that they didn't have to mark to market unless they were hedging. Then they would have to mark to market. But because they didn't have to, those losses remained sort of hidden. And so by January of this year, you had money markets or T-bills yielding 4.5% to 5%, and people started to say, "Listen, I'm tired of getting 0.3% on my checking account. I'm going to start to move this money to money market accounts." And so you started to see this shift, and then all of a sudden that shift started forcing banks to redeem some of the securities that they were holding to maturity, and they were redeeming those at losses, and so everything kind of tailspinned, and that's partly where we are today. Now, the other issue you have going on is a funding crisis, which is you have a lot of rollover of current debt in the marketplace. I think it's $5 to $6 trillion a year of existing debt has to be continually rolled over, and so that is a demand of capital on top of the new debt that's being created, by the U.S. Treasury or the public markets, that type of thing. So all this has to be funded somehow, and that funding is going to ultimately force the Fed to come back into the market and be stimulative or supportive and buying U.S. Treasuries, especially if this debt ceiling gets passed. And they start to come to market with more debt. There just isn't enough pocketbooks right now to buy all this debt, unless obviously that money comes from an asset class, which may be the stock market, for example. But there's no other way to fund the sort of crowding out effect that the U.S. Treasury could have if it starts issuing more debt.
Well, also you have China, Germany, and Japan. They're not recycling their trade surpluses back into U.S. Treasury. So the three of the largest buyers of U.S. Treasuries over the last 15 or 20 years are no longer buyers.
Right. Yeah. And as the dollar got really strong last year, you started to see countries say, "Hey, listen, it's not worth trying to get dollars at very high prices to try and maintain a trade relationship. Let's just trade our own currencies with each other." And you started to see some divergence starting to develop there. And of course, people say, "Well, that's the end of the dollar." It's not necessarily the end of the dollar. It's more of a function of trying to maintain your profit structure as a foreign entity dealing with maybe a country that isn't directly involved with the USA. So China, Brazil, or China, India, they can create their own relationships, trade their own local currencies back and forth, and try to save money from the volatility of an underlying currency like the dollar.
Well, I would say all these digital debt-based fiat currencies have immense problems. I mean, the dollar might be the best-looking horse in the glue factory or the cleanest dirty shirt in the laundry basket, but it's still not much better than any of these other fiat currencies.
Right, and that's part of the problem when you have a reserve currency. The structural deficits that we have, the constant need for funding, like you said, if countries aren't willing to buy treasuries and park their U.S. dollars there, that means they don't need the dollars in the first place, and that opens up down the road a funding crisis that I think ultimately we're going to see, and that's going to force the central banks to probably start expanding their balance sheets even more. But that's one of the reasons why, again, gold and silver to me make a lot of sense on a longer term basis, because watching the day-to-day price movements, it's easy to get swayed by sort of the bearish or bullish momentum that you see with commodity trading advisors and the commitment of traders reports and hedge funds and all that type of stuff. I think the important thing for longer term individuals that are buying physical metal is really the longer term picture or structural arrangement that this market actually is involved with. So you don't ultimately, the Fed is going to have to support not necessarily an inflation and employment, but they're going to ultimately have to support the U.S. government and the ability for the U.S. government to fund itself.
And the Fed's actually hurting itself with the higher interest rates, because the higher these interest rates are, the higher they keep the interest rates for longer periods of time, the more they have to pay out in interest payments on the reverse repo, the 2 trillion plus that's parked in the reverse repo, and all the interest on excess reserves, which is what they gave the large banks during all the many years of the QE program since 2008. So the Fed's actually deeply cash flow negative. The Fed does not have to adhere to generally accepted accounting principles. They're actually allowed legalized accounting fraud, like a lot of the U.S. government and the large banks too, since the FASB suspended mark-to-market accounting. But what you brought up earlier with the banks, I think that's really important. So when the Fed's raising interest rates, the average person doesn't understand that these banks are going to they all have portfolios of bonds. And if they need to go raise capital like a Silicon Valley Bank or First Republic, they have to mark to market those losses. So then finally, all the problems with the higher interest rates, all those old bonds, the value on those old bonds is taking enormous hits. And so now you have the problems with the banks. I think that's why gold and silver are getting more demand, even though it looks like the consumer price index is trending downward, is because if you study financial history, Bob, gold and silver look like a bankruptcy hedge. They've done very well as a bankruptcy hedge in the past, where there's deflation, a bankruptcy risk. So it's not just an inflation hedge, it's also a bankruptcy hedge.
Correct. Yeah. Solvency, systemic risk, counterparty risk. Correct. That's actually what ultimately drives precious metals. Maybe not as much as inflation short term. Over the long term, you can make an argument that gold has done a great job of keeping up with inflation over the long term. But you're correct. The short term. You get these fluctuations, and you get some structure involved in the markets that may dissuade people from owning gold, even though inflation is rising. And then, of course, inflation tails back down, and then gold takes off. And on a long term chart, it looks like gold's doing whatever it should be doing, but on the short term, it frustrates everyone. One important note with the banks, especially with the Fed creating that term funding program that basically bailed out a lot of the banks that needed capital, and they basically the mark to market, or the debt held to maturity was maybe worth 70 cents on the dollar, and so they got to basically turn that debt in and borrow 100 cents on the dollar on the way back out. That's what sort of saved the program. But what's interesting is that roughly about 300 billion was used as by the Fed. It increased their balance sheet by 300 billion. That went back to the banks, which then in turn funded all these bank account holders to basically take their money out, put it into the money market funds. And the funny thing about it is the money market funds, the Treasury money market or government money market funds, basically took that money and threw it back into the Federal Reserve in the reverse repurchase program. So 90% of that reverse repurchase program is actually government money market funds. And so now it's yielding 4.8%, that the Fed's paying 4.8% on this RRP program. And so that's actually a form of QE that's paying back to the money market accounts. So the money market accounts don't have to go into the market and try and find other short-term debt. It is a complete joke.
It sounds like a shell game here.
Yes. Yeah. Basically, the Fed is funding the bank runs is what's happening. And then those bank runs come back to the Fed. But the game continues on, and it plays on like there's, it's like where they talk about playing on the Titanic. Yeah,
musical chairs.
Yeah. But that's part of what's happening here, and so they're able to keep this mirage going on in the financial markets, like everything's under control. There's, the banks are in great shape, but in reality, you still have the funding issues of all this reoccurring debt that's going to be constantly need to be rolled over. Someone's going to have to fund that, and that's why I think the Fed can only tighten so far until, obviously, like people say, something may break, and of course, I think something did break with these banks. And then, and you have not seen the real issues start to crop up, which is the commercial real estate market, the mark-to-market of those loans. That you're seeing a lot of defaults with office buildings and so forth. The moratoriums with mortgages and car payments and student loans and rental and all that type of stuff. That's now gone. So now people have to pay all these things. These stimulative programs are not being supportive of the markets and the economy anymore. So now we're now out there floating without a life vest on. So that adds even more complexity into this environment.
And I think the average person, it's so complex, it's so difficult to understand. There's a lot of moving parts here. I mean, there's a lot of people going on TV, mainstream financial media, podcasts now saying that what the Fed did, loaning against collateral, it's not a bailout. But if you're paying 100 cents on the dollar for stuff that's worth at best 70 cents on the dollar, I mean, I've spoken to bankers off the record and they're telling me this stuff is worth way less than 70 cents on the dollar. Some of the stuff's worth less than 30 cents on the dollar. And then the Fed's claiming, and these people on these podcasts, mainstream financial media, is claiming, oh, the banks are going to be easily able to pay back the loans in 12 months. Well, did that happen during the repo crisis back in 2019? If I remember correctly, Bob, what happened is the Fed, Jerome Powell and other people at the Fed were saying very similar things, that we're just loaning against collateral here. And meanwhile, the loans back in 2019 during the repo crisis kept being extended and extended and extended. And then a couple months later, the Fed increased their balance sheet by $1 trillion. So unfortunately, I think the same thing is probably going to end up happening.
Correct. Yeah, and that brings you back to a confidence game. Ultimately, that investors are starting to pick up on this. We started to see this back in 2018-19, where high net worth investors were coming into the physical metals market as things were quieting down on the retail front. You've been seeing a very consistent amount of buying amongst very large investors that are saying, hey, listen, I made a lot of money in the stock market, or I've made a lot of money in my career. I want to protect it. And so you're seeing that need for physical metal, not only from a worry of counterparty risk perspective, maybe holding it with the bank or clearing firm, that type of thing, but you're seeing it with this realization, hey, I'm worried about social policy. I'm worried about tax policy. You got to remember in 2025, the Trump Tax Act back in 2017, all those tax rates are going to reassert themselves. They're going to basically have that sunset provision where they're going to go back up again. So you're going to have that issue become a potential political lightning bolt. And then you have again, you have this sort of I guess you could say private or sort of a protective environment where we're trying to bring jobs and companies back to the shore, but that's you're starting to see more rift or more tension between countries now, trying to compete with one another after 20 years of globalism. So you have that happening at the same time. I mean, there's a lot of structural issues here that, yes, money printing can basically smooth things over and make it look very nice on the surface, but underneath that surface, you have a lot of rot.
Well, the money printing doesn't benefit the average American. I mean, it just creates more stagflation, shrinkflation, and tax increases for a small business owner or the average worker trying to earn a paycheck to survive on their salary.
Yeah, definitely. Cost of living's been going up, and like you said, rent. I mean, for the younger generation, it's very difficult. I feel for where they're trying to grow up into an environment where the house prices were at stratospheric levels. To try and save money into the stock market with multiples as high as they are. What's the long-term rate of return you're really going to get by going into the stock market at these levels? And that's a function of, again, like you said, all this money printing. It may help the baby boomer generation or people with those assets, but it doesn't help the people trying to accumulate or attain these assets.
Yeah, I totally agree. I was actually speaking with a Generation Z person who's like 25, 26 years old, and I asked about their savings and diversification, and they told me they don't have enough savings to diversify. They're just putting all their savings into Bitcoin. And I just kind of did a facepalm.
Yeah, it's hard. I mean, and especially with what we've seen with the speculation, with all the money printing and the crypto going from zero to hero back to zero. I mean, it's taken people for basically a roller coaster ride. I mean, everyone's trying to say, listen, I don't know how I'm going to make it to retirement, and because everything's so expensive, and and that's the problem with the markets. You saw the same thing in the 1920s with the great speculation there and people going into the stock market and then everything blowing up. So I think that's what's attracting people to the metals today, is that silver is one of the only assets that hasn't surpassed this 1980 high. I mean, tell me another commodity or stock market indice that's still at 1980 or below 1980 levels. I mean, so that's what I think attracts people to say, hey, listen, I haven't missed the train, so to speak. And that cost of production, especially from the primary silver producers, has been continually rising the last 20 years. So that's been sort of a floor for the market over time as well. So you have a very interesting dynamic, especially with silver. And I think silver would be a great, attractive commodity or asset for the younger generation, because they can still attain it. They can still buy it. You can still, it's not very expensive. You can accumulate a number of ounces versus gold, of course, but it's something that they can touch, they can hold on to it, and ultimately, they could trade back. I mean, so there's a lot of advantages to it, but that's just more on the investment side.
So I want to ask you about the recent Silver Institute 2023 report that came out. Do you agree with the Silver Institute's newest report released recently that silver supply is now in a serious deficit?
It's interesting. I don't, their numbers, I mean, it's obviously proprietary work that they do. I've seen, like with CPM Group, they've countered that, saying some of these numbers are on the demand side or overcounted. Like if you go back to, I think it's Metals Focus's reports back in 2013, they showed enormous demand then, and you had a complete disaster that year in the precious metals markets. So some of the stuff you have to take with a grain of salt, I think, especially with some of these large supply deficit numbers, because sometimes when you start factoring in silver for investment, sometimes silver gets double counted there, because they may take coins and bars up and add that to the equation of investment demand, but those coins and bars come from that same silver that may have been pulled and put into more industrial sized bars or may have been counted in another category, and so you run this risk of overstating either the demand side or understating the supply side. But that's and of course, with prices going up, that price structure is ultimately what becomes the balancer between this. If we are in this type of supply deficit you're probably going to see higher prices. That's the only way you're going to see people sell back metal into the market, or you see scrap coming back into the market, where you have that other side. Because right now, for investors, the only thing they can really get their hands on is really newly refined product. You just don't see a lot of people selling back into the market.
The first time gold hit 1900 in 2011, and silver, I think, hit 48 back in 2011. I remember a lot of people were selling their scrap gold and silver jewelry, their silverware, their flatware. So there was a lot of scrap metal that did come back to the refineries in the United States.
Yeah, and I think it's very important to note too. A lot of people point to Silver Eagles, for example, and say, look at the premium on these products. That means there's so much demand. What in reality is happening is that there is a lot less product being made. For example, of Silver Eagles, back in 2013, 48 million coins were being made a year. Nowadays, it's only about 1 million a month, or 12 million a year, and that has there's a lot of sort of arguments.
So you're talking about for listeners out there, you're talking about the U.S. Mint. So the U.S. Mint, for listeners out there, is very inefficient. Don't they shut down before Thanksgiving now? So they take the last 6 weeks of the year off each year.
No, I don't know if they take it off. They make production. They don't actually. They start making the new year's production I think in November or October. So they start slowing down production of that current year, and they start to retool, and then they start making production. So when the January rolls around and that's when they start delivering the New Year's product. They'll have a more product to actually provide right up front, because a lot of people like to buy what they call first strikes, or as soon as possible when they come out. They get these. They like to get a lot of the collectors come into January and start buying, so they get that year's mintage, and so you tend to get a lot of product demand right in January, and so they start to make that product, as far as I think in October, November. So that I think that's what you may be referring to. The problem you have with Silver Eagles is that the U.S. Mint does not make its own blanks, and so they rely on vendors to make the blanks, and then those blanks are then shipped to the U.S. Mint at West Point, and those are then stamped. The problem you have, there's only one real vendor that makes blanks right now for the U.S. Mint on the silver side, and that's Sunshine Mint. And they've been constantly making fewer and fewer blanks, because they've been making more and more product for other clientele, or for their wholesaler that actually owns a 45% stake in them, which is A-Mark Precious Metals. They may make proprietary product and get a lot better markup on it. And so what happens is, and this is kind of interesting, because it flies into the face of what a lot of these gold promoters say, which is they blame it all on the U.S. Mint. But in reality, the U.S. Mint doesn't have any control over the vendors. And so what happens is, if the vendors don't make these blanks, it forces the premiums up on these Silver Eagles, because there's fewer being made. That higher premium in Silver Eagles then drives the premiums for all of their products. And so they can then start selling proprietary made products like generic rounds and bars and things like that at much higher premiums than what you may normally would see if there was another vendor making more Silver Eagles and the Silver Eagle premium wasn't as high as it is. That is where I have a lot of questions and concerns about the industry.
Isn't there also laws on the books saying that the U.S. Mint cannot buy blanks from outside the United States? So they're only allowed to buy from a certain vendor that they have a contract with in the United States. So they're only allowed to buy silver that's sourced inside the U.S.?
Well, I think that may have gotten I think that may have gotten reversed. I'm not sure about the blanks. I know from the sourcing side, they may take metal from outside the U.S. I think they have to be LBMA accredited bars, but the or COMEX approved bars. Or COMEX approved refiners, I should say. But the law that says they have to meet demand, that got repealed or changed, I should say. So now it's discretion of the U.S. Treasury Secretary so you don't have that requirement to make and meet demand, so to speak. And part of the problem is, I think the Mint, they're probably searching for another vendor to make this product or make the blanks. But the problem you have is the supply of material, the equipment, the location. I mean, to get the equipment just to make these blanks is a huge investment, and it requires anyone who wants to get into this environment to basically say, hey, I'm guessing that the demand for silver is going to be strong a year from now. But and I won't even be able to start making this product for about a year. So everyone is reliant, and then the U.S. Mint may say, listen, if we don't see a lot of people buying our product a year from now, we're not going to order as many blanks from you. So there's a lot of trepidation to get into this business of blank making. And that's part of the issue as well.
So if anyone decided to do that, it would be on speculation, because it sounds like they couldn't get a long-term contract with supply agreements then from the U.S. Mint if they wanted to be an alternate supplier then.
Exactly. Yes. Yeah, you just hit the nail on the head right there.
Yeah, I mean, I live right outside of Washington, D.C., so I know a lot of businesses that are totally reliant on government contracts and they overcharge the government. But I mean, in this case, the U.S. Mint should find alternate supply. It just sounds like it's going to be very difficult.
It is, and it's an issue with you've seen Republic Metals go under, and they were not that they made blanks for the U.S. Mint, but and you saw other companies like NTR and Ohio Precious Metals go under, which were longstanding. Ohio Precious Metals, a longstanding refiner, very well known. When you start to see these companies start failing or walking away, or let's just say 2018-19, when the industry was losing money across the board, it didn't want to make people go out and spend money to build out a mint or some type of refinery, not knowing when demand was going to kick back into gear. I mean, obviously hindsight's 2020, but who could have saw this COVID thing and then the reaction of government with all that money printing to this COVID thing? I mean, that's it takes the market by surprise, but that's what makes bull and bear markets.
And I've been covering gold and silver for over a decade. I mean, the average person doesn't realize this, but there's been a lot of bullion dealers that have failed in the last 10 or 12 years. I mean, there's Bullion Direct, there's Tolving, there's Northwest Territorial Mint, all for different reasons, obviously. But the margins for a lot of bullion dealers, unless they're coming up with scheming marketing, the margins for the bullion dealer business are normally not very good.
Well, they weren't up until COVID. Now it's like basically the premium or the spread between what they're buying product for and what they're selling it for is enormous. I mean, you can look on our website to see what basically our rates are. I'm a little bit above the wholesale rates. It basically shows you what a lot of big online guys buy for, and you can see ultimately they're maybe $2 to $5 higher an ounce in silver than I am in a lot of cases, and so there's a lot of fat there that's being paid out or that's being made. You just have to look at you look at the again, you look at the U.S. Mint. When the U.S. Mint sells their Silver Eagles to authorized distributors, which are the wholesalers, they sell it for $2.95 an ounce. That's the cost of Silver Eagles to the wholesaler. Why those wholesalers? You're saying
above spot price? That's above spot.
Correct, above spot. So all of a sudden you see the authorized participants selling, at $10, $11, $12, $13 over spot. That's an enormous markup, a profit center for them. And so one of the big online dealers, which is well known, is also an authorized participant or authorized distributor. Why they sell product for $15, $18 more than what their cost is for is beyond me. I mean, there's a limit to, if you're trying to get the public involved in the precious metals space and get them behind the product and get them behind the metal, don't gouge them. And that's what's really going on here in the industry. There's no oversight. There's no regulation. It literally is the Wild West. And what I'm trying to do is bring back this sort of this mentality that, hey, we got to take care of the consumer because that's our customer. But at the same time, the consumer is an investor trying to protect his purchasing power. There has to be an even dynamic here. Otherwise, what's going to happen is people are going to, which is what's been happening. They've been buying metals the last couple of years for the first time. They realize they overpaid for the metals when the premiums collapsed, and then they don't come back. They're like, why do I need to buy something that I have to make a 30% return on just to break even?
And that's the retail investor, the problem. Or they watched a bunch of YouTube videos and podcasts There's a number of different websites too that are predicting $150 silver in the next year or two, gold to go to $5,000 or $10,000 an ounce in the next couple of years. I mean, just these predictions, if you go back over the last 10 or 12 years, there's been too many of these predictions from a lot of the same websites. And unfortunately, Bob, a lot of these websites, if you check, they have affiliate marketing deals or they have paid advertisers with a lot of bullion dealers that are marking up those high premiums.
Yes, it is a very frustrating game because there isn't any disclosure. There's no transparency whatsoever. A lot of these promoters are pushing product because they're being paid to do that. They don't even understand the products that they're pushing or the structured programs that they're pushing. It really is a shame because, and that's what I try to do is on these interviews is try to instruct people to say, listen, read these user agreements, read the material that defines the responsibilities and liabilities of these programs. If you're gonna buy metals and store it at home, that's great. But if you're gonna buy metals and give your money to a program or have them stored at a facility, make sure you have a direct relationship with that depository. It's so critical because you want to eliminate as much risk as possible.
And unfortunately, I think the institutional investors, first of all, most of them hardly have any gold exposure. I think the average over 70% of institutional investors that are tens of billions or more assets under management, and there's a lot of those, have less than 1% gold exposure. But the ones that actually have gold exposure, Bob, they have GLD.
Well, it's GLD, but they also are involved with derivatives. It's structured products. It's easier for them to get involved in Wall Street made products because those products are a fund or a security at that point. And a lot of the charters of these institutional houses, or I guess funds that you could say, their charter says they have to be in either a fund or a security. They can't be in a physical asset, and that's one of the downfalls. I think that kind of hurts gold and silver because ultimately what happens is these structured products, these derivative vehicles, become sponges that soak up money that may have otherwise went to physical metal. That would have really pushed the metal. It would have made the physical market much more important and much more of a pricing mechanism than it has in the past. Now, what you are seeing happen with Basel III and so forth is you see the physical market coming alive from 2020 forward. You've seen open interest and trading volumes dry up on the COMEX. You've seen a steady decline after 2020's break. As interest rates have been rising, there hasn't been a need or incentive to go put your money onto the exchange, put that metal onto the exchange and start to short against that contract, so to speak, or roll it and that type of thing, because the financing has become more expensive because of higher interest rates. I mean, so what you're seeing is the physical market, as when prices dip, people are buying the physical product much more than they have in the past. You've seen that with in the exchange, like what the COMEX in the registered category, the level of inventories are down to 32 million ounces or so in the registered category. 3 years ago, they were 150 million ounces. You've seen the level of inventories on the London market drop to below 2016 levels, which is when they first started to kind of count all that inventory. So that's at the low end of their range. But and that metal is going to countries like India and other countries that are saying, listen, we see value in these commodities. We may not see value in the paper that these things are trading around, but we see certainly value in the physical.
And those derivatives that you're talking about, I would say a lot of them are meant to help suppress physical gold and silver prices because it's paper and people aren't demanding the metal. So that allows all these games, the paper volatility in the paper price for physical gold and silver and precious metal market manipulation. So all these extra derivatives, and Jeffrey Christian has even testified in a CFTC hearing in 2010, I believe it was, that there's over 100 ounces of paper gold for every real ounce of gold. And it's even worse for silver. But you brought up demand for physical. I mean, I think a lot of this gold tonnage demand, Bob, is coming from non-G7 central banks because they could go earn risk-free U.S. treasuries at over 4% now, but they're not doing that. Instead, they're saying, we saw what happened if you don't agree to the U.S. foreign policy terms or NATO terms with what happened with Russia and their reserves. So we're going to start diversifying away from U.S. treasuries. We're going to accumulate gold tonnage.
Right. Yeah. And again, also there's the concern, the long-term concern of what's the value of the dollar going to be? I mean, it doesn't take a rocket science to say, listen, at $31 trillion of US Treasury debt, there is only one way to keep that or maintain that level of asset value, and that's to print the money and ultimately devalue the currency over that period of time to try and inflate away the debt. And so countries are seeing that. I mean, they're seeing it obviously with Japan, doing that, the sort of yield curve control, I guess you can call it, and that's a big concern going forward. I mean, that's what you said. I mean, do you earn 4% in a U.S. T-bill or a U.S. Treasury, or 5%, or do you put it into a commodity or diversify it into other commodities or local or other currencies to try and say, listen, maybe it's better invested in my own country than invested in a U.S. Treasury. That theme has been playing out, the last 10 years.
And the U.S. Treasury has control of those treasuries. So if you own a large amount of treasuries, your reserves, they're not all controlled by the government at that level. They're controlled by whichever country you're recycling your foreign exchange reserves, your trade surplus back into, which is the problem that Russia got into with their reserves being taken control. But now Russia is just accumulating. They're buying their own gold mining inside Russia, and then they're buying extra physical gold tonnage. Same thing with People's Bank of China. So you're seeing all these, I think Singapore just bought a lot of gold tonnage recently. It's mostly all the central banks that are buying a lot of physical gold are outside the G7.
Yeah, and I think that's partly, you can make the case that down the road that there may be a basket of commodities that may be commonly owned, that maybe start to use to try and develop some sort of balance between whatever currency may ultimately be the next reserve currency, or there's some commonality of transfer of payments that, okay, I can value your currency based on your reserve balance, which is made up of a plethora of different commodities or currencies. It may be easier to kind of compare apples to oranges. And that, because obviously the advantage of the dollar as a reserve currency is everyone just trades the dollar, so it's easy to understand and recognize. But it's getting to a point where those dollars, to maintain that dominancy, I guess you could say, it requires countries to give up their sort of solvency or sovereignty, and I think that's where these countries are starting to kind of kick back and say, listen, if the economies are starting to recede, we got to start doing what's best for ourselves, not what's best for somebody else.
I think also we're starting to see a lot of physical gold demand increases from the private sector in China. It's really coming back the last 6, 8, 12 months compared to the last couple of years. I think the demand levels are back to 2017 or 2018 levels, which are some of the highest over the last 5, 6, 7 years. And I think a lot of that's because of the real estate market collapsing in China and the Chinese government's response to this with the lockdowns and the money printing and trying to save their banks and the real estate developers. So the average Chinese investor doesn't have the same options that a Western investor and an American investor does. So buying physical gold or physical silver is one of the best options for Chinese investors. And I think we're seeing that in the Swiss gold refiner exports into China on the export data.
Yeah, and it's not only that, it's supported by the country. I mean, it's there's a tradition, especially like India. I mean, there's a lot of tradition and rich history with owning gold as not only as an investment, but basically you wear it as a bank account you wear around your neck. I mean, it's that a lot of people see that's a lack of counterparty risk at that point, because it's what you have on you.
Well, I don't know. If you're wearing a lot of expensive gold jewelry, Bob, that means that you're more likely to get robbed, though. So, I mean, like, it's probably smarter to put it in some type of safer vault.
Yeah, definitely. But that's the culture out there. It's there's an affinity for physical assets. But whether it's trust or whether it's just the nature of that tradition, it provides more stability, I guess, and it basically allows just like in the U.S. where we have half the population has guns, and that Second Amendment kind of keeps a check and balance, the ultimate check and balance on government. Well, back in those countries that have an affinity for precious metals, like India, it allows those citizens to say, hey, listen, if you're going to just print your rupee into the ground, we find more value in owning gold and maintaining our purchasing power or maintaining our wealth.
So I have a couple more questions as we wrap up the interview. I want to get your thoughts on the supply side for gold and silver. So for our listeners out there, the majority of physical gold and silver supply, they're a byproduct from mining for base metals. So do you expect the production costs for gold and silver, because they're a byproduct for base metal mining, to keep rising over time, and then that's going to put price floors in for physical gold and silver over the long term?
Yeah, I think you see a consistency. There's a lot of good analysts out there that have done great work in terms of showing that production numbers, that metals tend to bottom where you see the cost of production start to kind of come in, especially amongst the primary producers, because like you said, with the producers that use gold or silver as a byproduct of mining, or especially silver as a byproduct, they tend to say, hey, listen, we just give the silver away. That's not really our mainstay. But I think it's important to notice that, especially in the silver industry, 30% of the silver mined is from primary producers. So you can that 30% represents sort of the at the margin of where price can get moved around a lot. And so that even though 30% doesn't sound like a lot, that can have an impact on the overall price structure of the market, the tightness and supply that comes in, because about 70% of the usage of silver comes from industry. And so the investment side drives a lot of this price action. So I think as long as the government's going to continue to go into debt, and ultimately they're going to have to fund these debts and all this reoccurring debts that are coming due every single year. This and refinance that. You're going to see people sort of be mistrustful of the government and the ability to say, hey, listen, inflation is going to be sticky, and all these issues are going to be centered around the confidence of money printing is going to have to continue at some point. Otherwise, if this economy starts to go down, it becomes a self-reflexive doom loop almost, because the debts are so huge. There's no way to manage or service these debts once you start getting into sort of a deflationary spiral. And of course, that's what central banks are trying to avoid like the plague.
Well, the governments hate deflation because they can't tax it. So you have the U.S. federal government that's gotten, and the state and local governments that have made property taxes, enormous property taxes for many, many years. They keep raising them, which is just ridiculous. But the U.S. federal government has made capital gains taxes on stocks, bonds, real estate, inflating them with the Cantillon effect. You brought up deflation, though, in a bust. I mean, I've seen bears out there calling for silver to crash down to $10, for gold to go way below 1,000. If that happens, Bob, I mean, a lot of these mining companies, especially the silver miners, there's very few silver miners that can produce silver for anything close to $15 an ounce. Most of them are $18 to $22 an ounce at best for their low cost. We're looking at large scale bankruptcy similar to what 2015, where there was almost the entire industry almost went bankrupt. I mean, I was getting emails and phone calls from people almost every single day at that point. 2015 was that bad that a lot of the miners were that close to bankruptcy.
Yes, I think you made some really good points there. Yes, the prices could spike down. I mean, we've seen it like with 2020. We saw it with 2013 when prices spiked down, or 2008 prices spiked down. But as long as you're a physical investor owning it in cash, you don't use you don't associate leverage with your investments, you can weather that storm. I think that's the important thing to basically look at when you're buying metals. They are volatile. They can shift in price quite a bit. But at the end of the day, you're right. If they're below the cost of production, you're just going to see mines. They may not shut down because it's expensive to try and restart, but they may just start to reduce their supply and production to a level where they can just minimize the losses as much as possible.
Well, the miner's going to go bankrupt, or they're making phone calls to sell out. I mean, that thing basically happened with Alexco recently in the last 12 or so months because they couldn't produce at the spot price. They couldn't get a good cost of production. They had capital problems, so they were on the phone trying to get a company to buy them out. So that happens in times when cost of capital is high, and the metals prices. The producer is producing above the spot price, so their cost of production is above the spot price, so they have negative margins. So we may see that again. I mean, this is unfortunately, the miners just don't have access to easy capital, and especially with higher interest rates, their cost of capital for a lot of these miners, unless they're a large miner like a Newmont Mining or an Agnico Eagle, their cost of capital is going to be sky high.
Well, and again, that's where you watch, the paper price versus the physical price. I mean, we saw this happen last fall, where especially in the summer, as prices started to drop, CTAs, commodity trading advisors, were shorting the COMEX contracts into the ground, basically with this idea that, okay, the Fed's going to be tightening policy, so therefore let's just sell everything. And what ended up happening is you went into a backwardation, meaning the physical spot market was worth more than the actual lead month futures contract, say 2 or 3 months down the road. And that was a sign of tightness starting to develop, meaning people could care less what the futures price said. They see value in the physical metal. And I'm sure you'll see the same thing start to develop. If you see a big sell-off in the market, the spread or difference between the physical and the futures price will again be go into backwardation and start to and that creates problems, and that creates tightness, because what happens is refiners have problems trying to attain metal to make product or to provide supply or production to industrial customers. So just saying, hey, listen, gold's going to go to $1,000 an ounce or silver's going to go to $10. It's easy to say that kind of stuff, but in reality, if it happened, you'd have supply chain problems, thrown everywhere, because there's no incentive for anybody to sell their metals unless they were forced to. But the public isn't going to, certainly, if they're not going to sell at 25, they're certainly not going to sell at 10. And in fact, they're probably going to buy more at 10 if that does happen. And I think that's this equaling factor of watching the cost of production versus whatever the current price is at that moment. And I think that's why, to me, what you're seeing right now in the marketplace is that the silver market really looks like it did like in 2010, where you just had a major shock in the market a couple of years prior. It shook people up a little bit. They're not trusting of the market, but the market now is starting to sort of rise at this, where people are not really trusting the rally. We've all been kind of accustomed to say, listen, the price of silver goes up $5 an ounce, and all of a sudden here comes the 2x4 across the head and knock it back down. Well, if we start to see what happened in 2010 and early 2011, where potentially the market does these high-level consolidations and then starts to work itself higher, we're not really well positioned right now amongst the discretionary fund managers, the hedge fund guys. They really aren't that long the market right now. Yes, the CTAs aren't short anymore, and they've gone long. They're net long right now, but they're not nearly net long where they typically may have seen them back when silver was in January. They had larger long positions back then. In fact, there were about half to a third of the position where silver was around $27 back in this time last year with the Ukrainian incident. We're only about a third of that open interest in the silver contract. So
are the commercials covering the shorts though?
Yeah, they were covering shorts. They're getting short again, but they're nowhere near their size of their short position, this time last year. So those are things that I watch for in terms of if you're saying, hey, listen, okay, are we topping now because now that the speculators are going long, does that mean the party's over? Not necessarily. I mean, it's the physical market. It's the demand. It doesn't take a lot to move on the physical side to move a lot of physical out of these vaults. I mean, you look at the 32 million ounces that are sitting in the registered category. We could stick all 32 million ounces in our facility here at our depository. I mean, tomorrow. It doesn't take a lot of space and money to do that, especially, you're talking about $700 million or so of metal. I mean, that's not a lot. Or
Aren't there there's position limits though on the COMEX, right? They put those with the Hunt brothers. They started changing the rules on them, so there's a certain amount of futures contracts on the long side. It's just for gold and silver. The average person doesn't understand this, right? So for other commodities, there's no position limits, but for gold and silver on the long side, you're not allowed to have more than a certain number of contracts unless you have an exemption like one of the bullion banks.
But yeah, they lifted that actually, which is kind of interesting. It used to be 1,500 contracts that you could take a position limit with and take delivery in 1 month. They now doubled that to 3,000 contracts. So that's 15 million ounces that literally you could stand for delivery in theory and say, okay, I want the metal. And then just, you load up and you can put about 600,000 ounces into a semi-tractor trailer truck, and then you ship it, wherever you want to ship it to.
Are industrial end users actually getting delivery of these COMEX contracts, or are they going to the refiners or wholesalers?
Traditionally, it's been they just go to the refiners. They have relationships with the refiners, because a lot of the industrial users, if you're talking industrial like corporations, they may want it in a specific form. It may not be the 1,000-ounce bar form. It may be some other type of form. So depending on what their need is, but from an investment standpoint, the 1,000-ounce bar in the silver market is really the Achilles heel of the entire industry. I mean, if you get a run on 1,000-ounce bars, the 1,000-ounce bars is what funds the ETFs. It's what institutional holders will buy. It's what fabricators typically will get their hands on when they're making smaller bars and coins and that type of thing. So if you can choke that off, for example, that actually will have a huge price impact, because that's really where like the exchange for physical is based off of that 1,000-ounce bar.
That's interesting. Yeah, I remember David Morgan, I think it was 2010 or 2011. So this, as silver was going up a lot. No, I think it was 2008. It was 2008 because the premiums on eBay, I think, were over $10 an ounce on eBay. So David Morgan was, through his refiner contacts, he was getting 1,000-ounce bars, and he was having them melted down into smaller bars and rounds. And then he was reselling them and getting those higher premiums.
Yeah. And you would see that. I mean, you've seen that there's been a big push in the retail industry to make proprietary product, which opens up another door of other problems, because these retail dealers are saying to themselves, listen, I can make a fat premium on buying 1,000-ounce bar, melting it down, and selling a proprietary made product for maybe it costs me maybe 75 cents to $1 an ounce to make, and I'll sell that bar for $3, or $4, $5, $6, $7 over spot. But when the problem is when the client goes to sell that back, it's a proprietary made product. It's not made by an LBMA refiner. So wholesalers may not support that product, so that it may be considered scrap metal at that point and go for whatever melt is, or a discount to melt. You may not see that product be supportive except by the dealer who maybe have originally sold it. Those are all risks that start to come into the equation of the investor, which they may not fully understand.
So what you're saying then is, if anyone tries to resell that silver coin or bar that they bought, even though it's actually silver, and if you tested it, there's no impurities, someone didn't dip base metals into silver, it's not cheating like that, but just the scrap value, or the refiner won't pay anywhere near spot prices for it?
Right. I mean, look at like Northwest Territorial Mint. They made their own proprietary products. If you go to sell that bar, you're not going to get what you may get by selling a Royal Canadian Mint 100-ounce bar, for example. If you look at the elemental situation where they were illegally bringing up illegally mined gold out of South America, and they got nailed for it. When they went bankrupt, they took down NTR as well as Ohio Precious Metals. If you have that product, you're probably not going to get the same value. You're probably going to get a discount if you can find a wholesaler to buy it, you'll probably just get, not get as good of a price as you would as, an LBMA accredited or a COMEX accredited hallmark. And that's important to understand, because that opens up this spread risk of what you pay for it versus what you sell it for. Kind of like when you're taking a new car off the lot, you're going to have depreciation. Well, it's very similar when buying metal if you pay too much premium for it up front.
Do you track the premiums at other bullion dealers to see like who's gouging on prices and if you're competitive? Excuse me.
Yeah, I watch a lot of them. There's a couple of really good programs out there that you can get in terms of apps that try to that does sort of that aggregate or scrape a lot of data, and they try and they'll do a lot of that for you actually, so you don't have to do that as much. That's something that that's one. I think metalmarkup.com is one of them. That does a lot of scraping of data, and they scour. They don't have any allegiance to anybody. They just look at simple price and try to reflect and say, hey, listen, this dealer is offering it for the best price on this specific product. So there are some aggregators out there that do that type of thing. But everything that I look at when I look at online, I'm beating everybody, especially the online guys out there. I'm beating them all. And it's because I know what everyone buys for. It's, I'm buying from the same distributors and wholesalers that a lot of these guys buy from. It's a small world. And so it's, to me, I just simply say, I want the client to have the best value possible, and I want them to have the opportunity to make money in this investment class. I don't want to take from their purchasing power, and that it just, being 30 years in the business without having a client complaint, I have a high degree of loyalty to the client.
Well, it sounds like you're doing a good job over there. If my listeners want to take a look at your companies, how do they do so?
Yeah, you can just go on our website. It's goldsilvervault.com. Just all one word, goldsilvervault.com. VAULT. We have a pricing page for metals. We have our fee pricing for what we charge for storage. We also provide logistics support. So if you're trying to ship or move metals, we can provide support on that as well. And then, and in full disclosure, I do manage a hedge fund that's invested in physical metals as well. So I kind of, not that I want to talk up the hedge fund, it's just that I am invested in that fund in physical metals as well.
So that's how you track the COMEX contract so much, because you're looking at the paper price and you're looking at the derivatives. Because I've been checking out your Twitter and you're just posting stuff about the gold and silver derivatives market, and you're finding stuff that other people aren't finding.
Yes. When you manage money for as long as I have, you look at the markets differently. You want to understand the market structure. You want to understand why the markets move like they move and react how they react. It's not simply saying the dollar is going to fall apart and the whole place is manipulated and the banks are making all the money. If you really look at what's happening in our industry, and I hate to say it, but the industry itself, the dealers and the promoters and there's a lot of bad players out there that have vastly overcharged. You see a lot of this with fractional coins, being made, with the Royal Canadian Mint with the Perth Mint, where they make these 2.5 ounce or 1.25 ounce. You see these dealers pumping these coins with these really fat premiums. I'm trying to open up people's eyes a little bit and educate them to say, listen, you have some choice out there. Try to do as much research. Try to shop as much as you can. Don't listen to the guy on YouTube, and say that's the guy I want to buy from. Try to understand there's a lot of good dealers out there. There's a lot of good local dealers out there that are very knowledgeable, that are, being overshadowed by a lot of these big online guys. And I want to try and support, especially a lot of the dealers that are trying to do the best thing for their client. It's just a shame that, these big dealers, big online guys, which have a big pocketbook and they're making a fortune and they're throwing that money right back into marketing and advertising to try and get more and more people swept up in it. It's just a shame that overshadows a lot of, other players out there that are trying to do a very good job for their client base.
Yeah, and a lot of times the YouTuber, the podcast, or the website with high traffic isn't disclosing that they have an affiliate deal or that they were paid for advertising in the bullion dealer. Unfortunately, it's the same type of thing for a lot of these junior mining stocks. I used to get emails every single day from people that would watch all these YouTube videos and they'd be buying all these junior mining stocks that advertise on all these YouTube videos. And they wouldn't look at any of the annual reports or financial disclosures or executive compensation tables for the junior mining company, how much the junior mining executives were paying themselves or were paying to the stock promoters or stuff for marketing. So a lot of these companies were just garbage and they were wasting shareholder funds. And then I'd get emails about them and I'd be like, did you even read any of the stuff about the company? No, I saw it on a YouTube channel I trusted. He was promoting it, said it was a good company, and I bought $10,000 or more worth of shares. And I was just scratching my head. I can't believe people would actually do this.
It's tough, and I get the idea. Everyone wants to hit the home run. It's embedded in all of us to be part of a big winner. But yeah, it's seeing this for 30 years. It's one of the reasons why I try to tell people, there's a difference between owning physical metal and buying mining companies and then investing in structured products. The physical metal is time in the market, whereas the mining companies are timing the market. And I think there's a big distinction that has to happen between the two.
If you're buying physical metal, also, I would caution people about trying to get rich quick on physical metal. I mean, buying physical metal, you're buying it for portfolio insurance, you're buying it for diversification, you're buying it to preserve the purchasing power of your savings. You're not buying it because you saw some YouTube video or podcast say that silver is going $150, $200 an ounce. Well, if you are buying it for those reasons, you're going to be sorely disappointed.
Yeah, and at some point, we will see I think a big liftoff in the silver market. You'll know when we're seeing sort of euphoria. I mean, silver goes up like a hockey stick at that point. But that's one of the reasons why I keep saying you haven't seen that movement yet. I mean, like the nickel market when it went.
Well, we had it in 2000, Bob. We had it in 2011. I mean, silver was going above 48, and look at all the rules changes on the COMEX. They forced cash settlement. Look at all the crazy stuff they did.
Yes, no question about it. But in 2011, if you look at it, it was the paper markets that really drove it, past 35 or 40. It was the paper markets and that roll that really the futures roll that actually moved it, to that level. You didn't see the physical market being supportive of that. I think the issue you have now is that we're in a period where this isn't a U.S. centric problem anymore. This is a global problem with global debts and refinancing of those global debts. Every central bank out there is forced to expand their balance sheet over time, and it's a different. Even in 1980 was a U.S. issue primarily. I think. What we're walking into is a recognition by global investors to say, listen, all these fiat currencies, do they really matter much if you have all these debts that it really can't be funded? I mean, these pensions that we don't even know what the extent of the problem with insurance companies have been because they aren't marking to market their portfolios. I mean,
same for pension funds. Yeah, they're not marking their commercial real estate losses or their bond losses yet. That's coming.
Yes. I mean, you just had a $92 million default in New York City today with office space. I mean, it was reported. I mean,
two weeks ago, DC had 160 million on a commercial real estate developer on the bond. So yeah, we're starting to see in the headlines.
Yes. Yeah. And that is what you're seeing right now, I think, is a shot across the bow. It's the markdowns in a lot of these other securities and asset-backed loans and so forth is really what's going to be the real pressure on the balance sheets of these banks. And that's why I think the physical metal offers a sanctity of not having counterparty risk or worry of, hey, listen, a return on your money. Now you're just really looking at a return of your money. And that's what I think what drives people to the physical metals. And I think that's why a lot of people buy it ultimately is that they're saying, I don't know where the price is going to be, but at least I have it in my hand.
I think the price will be trending higher because I think gold and silver are going to have to go up with the cost of production. I mean, the cost of, even if we have deflation, right? for these mining companies, the cost of capital is going up. If you look at the grades for the miners for my voice is starting to go, we should wrap up here. Whether it's a copper miner, a silver miner, or gold miner, I mean, the grades over the last 10, 15, 20 years, they're just trending downwards enormously, which means that low cost mining, high grade, low cost mining, those days are pretty much over, especially for a copper and gold miner that's doing open pit mining. I mean, those grades were below a gram per ton.
Yes. And you haven't seen those big production, those mines that have just gravitated headlines of massive finds or discoveries, I guess you could say.
Well, Bob, you are a wealth of information. I want to thank you so much for your time. We'll have to have you back on again in the next couple of months for another update on the commitment of traders and the supply side for gold and silver.
Sure, I appreciate it. Long time listener, Jason. Thank you.